Chair. And Mr. Chairman, it's good to see you as always.
You as well.
Many of my colleagues today, of course, have expressed their concerns about the upcoming Basel III revisions, and I hope you'll continue this dialogue with the committee once the joint rule is proposed and open for public comment. I'd like to follow up with a topic we discussed back in March. I'm sure you're keenly aware of how important it is for banks and companies to manage interest rate risk. Participating during the last several years, the Silicon Valley Bank made that very clear. Could you speak generally to how hedging interest rate risk is an important risk management tool for U.S. banks and companies?
Well, I think you see the reality of it here. When rates go up, banks are encouraged by their supervisors and their own internal personnel and risk committees that they need to manage that risk. And most U.S. banks did a good or adequate job of that, I would say. But it's a fundamental risk of banking, one of the most basic risks, along with credit risk.
Exactly. And on that point, I've heard concerns that the Fed's Basel III revisions could increase costs for derivatives end users, whether hedging interest rate risk or commodity price risk. I'm optimistic that these concerns will be addressed. Having said that, these revisions to capital requirements do not exist in a vacuum. The SEC is proposing major changes of their own. Last week, I asked Secretary Yellen if Treasury is coordinating with the Fed and SEC on economic analysis necessary to understand the potential consequences of U.S. banks implementing both significant market structure changes and increased capital requirements associated with market activities. The Secretary responded that the Fed is, in fact, coordinating with Treasury on this analysis. Are you aware of this coordination, and have you personally been a part of these conversations?
I have not been a part of those conversations, but I do understand that that's correct.
Okay. Chairman Powell, I'd like to follow up with you on your conversation with Congressman Gonzalez from earlier today. You have assured this committee that the Fed is not a climate policymaker, and I appreciate your commitment to this. However, I'm concerned that the Fed's regulatory toolkit would be utilized in a way that would, in effect, require the Federal Reserve to make policy decisions on climate change. We've seen other U.S. financial regulators embark on significant climate rulemaking, such as the SEC. Chairman Powell, are there principles you keep in mind when ensuring that the Fed doesn't give in to, shall we say, political pressure around things like climate change?
There are, and for starter, one would be that we don't see it as at all appropriate for us to tell banks what legal businesses they can lend to. That's not our role. We don't allocate credit. So what we do is we supervise banks to make sure that they understand and can manage the risks that they're running. And we're thinking of that as our point of contact with climate change, in the sense that it's another risk that over time banks need to be able to analyze and assess. So, but fundamentally, though, as I mentioned earlier, climate change is going to be a very important issue for a long time, and it needs to be addressed principally by elected people, because it has enormous distributive consequences, and we don't have a mandate to deal directly with climate change as a policymaker. It does arise in connection with bank supervision, but that's not the heart of bank supervision. That's just a small part.
I very much appreciate those comments, Chairman. On another topic, I'd like to discuss the Fed's balance sheet, which currently stands at around $8.5 trillion. As you know, the size of the balance sheet more than doubled as the Fed worked diligently to stabilize markets during the height of the pandemic. Now, as the Fed begins to reduce the balance sheet, could you explain this process and describe the levels of securities that the Fed would look to maintain in the long term?
So the way the process works is securities mature, and they roll off our balance sheet, and that's the way it works. And there's a cap for MBS, mortgage-backed securities, and also for Treasuries, so it doesn't get too large. And if you hit that cap month upon month, it works out to roughly a little less than $1 trillion a year in shrinkage, which is a whole lot faster than what we did in the last cycle. But then again, the balance sheet is that much bigger. In terms of the level, we're thinking about a level that will allow us to operate our abundant reserves regime with enough of a buffer on top of it so that reserves won't accidentally become scarce. I can follow up more with you on this.
Thank you. My time has expired, Madam Chair.
Gentleman yields back.